Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day, Overtime Edition. On Tuesday's Stock Play of the Day, we discussed the SLV. That is an ETP that tracks the price of silver. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest. On Tuesday's Stock Play of the Day, we discussed the SLVs. In particular, we talked about a long call in the SLV. I'm showing that strategy here inside the options playbook. And what our goal is to buy a deeper in the money option contract to act as a surrogate for the underlying stock. So we looked for a decent delta. In other words, we bought an 80 delta call option, meaning that if the stock went up 1, we should get 80% of that stock price representation, meaning that the option contract should go up about 80 cents relative to it. Talked a lot about why we decided to pick this call option as opposed to buying the stock outright in general. And let's see what happened with SLV this week then. We actually have a 15-minute chart here. We always tape the Stock Play of the Day live, so we're dealing with live markets. So this is noon Eastern time on Tuesday, which was the 6th. Obviously, Monday there was no trading because of a market holiday because of the 4th of July. So these are 15-minute bars, so it stayed flat pretty much all day. A little bit of a jump up, but really not much. If you look over here on the right-hand side, on our axis here, we see that we're only talking about 1-point movement. So not a lot of volatility, not a lot that happened. Market ended up down all day yesterday. Now it's back up a little bit. So basically, it's like never mind. Nothing really happened. Market pretty much stayed the same course. Now, if we look at the big chart, what we're kind of highlighting here on the silver chart is the moving averages. We see that the 50-day moving average crossed over the 20-day moving average crossed over the 50-day moving average, which is usually a bad sign for the marketplace. I call that a death cross. I don't put a lot of weight into it in these day and ages, but it would be nice if we would have broke up above the 20-day moving average. And this was the day that we were looking at. This was the candle, kind of hoping that we were going to get a breakout. This is just a real interesting level. I'm going to keep my crosshairs on here. Just if you go all the way across and you see there's some breakout to the upside and hopefully looking for a new channel to the upside. This was a big gap down in the marketplace that happened way back in September in silver. So overall, the chart, it just looks kind of blah, not too much going on. Stock hasn't really done anything. So we would just stay the course. We got a little bit more of a longer term option. So let's look at the strategy that we did. Silver today is up 21 cents. Trading at 24.22. We went out to the July 30th expiration, 21 days out. We bought the 23 strike call option, and I'm highlighting it here inside the Ally Invest option chains. Here are the calls. We have 21 days remaining now. If we click once over here in our checkbox, it puts it down into our option strategy workbench, and it shows that we're basically trading right where we were at when we did the trade. I think we paid 138 for it actually. Basically on paper, because it's always meant to be a paper trade, not meant to be a recommendation, on Tuesday overall. So you'd be looking to stay the course. Callie Cox, my colleague, was actually talking about silver usually having good months in July and August going into the end of the season, the seasonality of silver just in general. The gold marketplace has been looking pretty good overall too. So in general, just as a hedge for an inflation, silver or gold, but in this case, we're talking about silver, you might want to buy a little bit of it, try to help out your portfolio overall. And you can do it very inexpensively by buying option contracts. And part of the reason why is it's a lower price underlying, trading around $24. And on top of it, there's just not a lot of implied volatility. I'm going to highlight the IV column here inside the option chains. And you see you're only paying about 24% implied volatility overall. So stay the course. That would be the plan. A lot of times when we look at buying 80 delta option contracts, I'm going to highlight a different strategy that we talk about a lot on the stock play of the day overtime, which is a fig leaf. So we have that deep in the money option contract that's acting as a surrogate for our stock. A common thing that people might do if they get a little bit of a run up in the stock is maybe sell a call against that position. Now, if I had the underlying stock, that's very common. Try to bring in some income, give yourself a little bit of a pillow on the downside or a little bit of buffer if the stock were to go down, and just do it as a hedge in that position. And if the stock continues on up, well, you just get it called away from you. That's a covered call position. In the deep in the money call option, a lot of people will call this a leverage covered call. Inside the playbook, we termed it the fig leaf, which means that we're kind of covered in that we have something that acts a lot like the stock, but it still isn't the stock. So our goal is not to actually get called away. It's a very common strategy that we've talked about on these FOMO trades, fear of missing out, where we're using liquid option contracts with tight markets like in SLV as a surrogate for the stock, protecting us against the downside. We said if the underlying came down to our strike price, we might think about getting out of it. That's basically our line in the sand overall. But by doing the fig leaf, we would be bringing in some income to try to help battle a little bit of the time premium that we still have to buy when we're buying an 80 delta option contract. So if we go back to the option chains, I'm going to show you something in the fig leaf, and I'm going to talk just a little bit about what's going on and why I wouldn't do it overall. So we had the benefit of buying this deeper in the money call option, only paid 138 for it overall. And the main reason why we paid so little and got so much is that it was trading at a lower implied volatility, right around 24%. If we look at the 7-day contract, these are different expirations. We got the 7-day, we have a 14-day. I'm just going to look at one that's 7 days out. And I think, gosh, I wouldn't mind selling some premium against it, waiting for silver to maybe break out to the upside, break above the chart to look a little bit better overall. Maybe I will sell a call option against it. Well, there's no time premium, right? On a 7-day option contract, you look at the 25 strike, you're only getting 6 cents by 7 cents right there. Good tight market, but you were just not getting anything for it. So I can add the 14-day and it's pretty much the same. If we look at the 25 strike contract on the 14-day, you're getting 14 cents by 15 cents. So I really just wouldn't sell it. I would stay in the position, and that's the way that I would approach this going into the summer, as we head into August, I should say. We're about right now. We got 21 days remaining on this July 30th option contract. So for the stock play of the day, the paper trade would be to basically do nothing, just stay the course. And that's it for this edition of the stock play of the day overtime. Please make sure you click subscribe and ring the bell, and we will see you this Tuesday for the next stock play of the day. Thanks for coming, everyone.